The LCycle tool resulted from a multi-year research effort that studied factors that affect development costs for affordable rental housing properties and factors that affect the long-term viability of affordable rental housing properties. The full team included representatives of the National Housing Conference and its Center for Housing Policy, the Compass Group, and our statistical partner, Summit Consulting. We would also like to thank the John D. and Catherine T. MacArthur Foundation for their generous support of this project. Any opinions or errors, however, are ours alone. In case you're not familiar with NHC, we work in concert with NHC's members to help ensure safe, decent, and affordable housing for all Americans. NHC engages in evidence-based advocacy, provides tools for effective communication, and deepens our understanding of housing issues through the research of its Center for Housing Policy. Our work on lifecycle underwriting is a prime example of the importance of having a combined team of research and policy minds at NHC, and of our commitment to partnering with others, such as the Compass Group, to add specialized knowledge wherever needed. My name is Maya Brennan, and I'm a Senior Research Associate at the Center for Housing Policy. Joining me on this webinar is Charlie Wilkins of the Compass Group. Charlie led the team that developed this software. He will take you on an in-depth tour of LCycle today, showing you how to use the tool for a fairly typical property, how the tool can help with modeling alternative approaches, and showing the tool's capacity for customization. Now that you know a little about us, we'd like to know a little about you. So I'm going to open up a poll here. You should be able to take a moment to select the occupation category that best fits your role. And once you've had a chance to get that in, I'll show you the results. Looks like most of you are about done voting here. I'm going to share the results with you. Looks like we have a fair amount of people who didn't fit into the relatively limited number of category options we could show here, but a large number of affordable housing developers and folks from other government roles, and certainly a decent showing from the HFA universe as well. So your input is really going to be important in today's webinar. This is a really interactive approach here, and if you have questions about the tool's underlying assumptions or specific scenarios, customization, or any other issues, please ask us using the question box in the GoToWebinar control panel. So before we begin with the heart of the webinar, just a couple more introductory notes. I'm going to first address technical difficulties. While we hope the webinar runs smoothly for everyone, we all know that this doesn't always happen. If you do run into any technical difficulties during the webinar, please use the chat box in the GoToWebinar control panel to send a message to the staff so that we can help resolve the issue. If that does not work, please email us at chp-feedback@nhc.org. Next, another frequent question, is this being recorded? Yes, an archived copy of this webinar will be available afterwards. We'll send a link out to everyone who registered once the recording is online. So now let's start thinking about LCycle. LCycle is a free online tool for comparing the life cycle costs of a property with the funds available for capital repairs and replacements. The tool walks you through inputting some basic information that should be all readily available pre-development, and then shows the estimated cost of the property's capital needs each year compared with the estimated replacement reserve balance. This provides an advanced window into the adequacy of the property's reserves. Is there a shortfall? How big is it? And when does it occur? Why did we develop LCycle, and why should you use it? One of the early findings of our research into properties' long-term viability was that many properties have replacement reserve funding that is not adequate to fund their likely capital needs. The costs of major repairs and replacements, such as appliances, floor coverings, heating and cooling systems, roofs, sidings, windows, things of that nature. In our sample, a few properties' reserves were likely to run out of money at year 10 or even earlier. Starting at about year 15, many properties' reserves became inadequate. Yet 7% of the properties in our sample had replacement reserves that were actually adequate to cover 50 50 years of estimated capital needs. But how do you know which group you actually fall into? During our research, Charlie and others from the initial research team met periodically with an advisory panel of housing research experts, policy experts, and experienced practitioners. They believed that this sort of early and quick analysis of expected life cycle costs and reserves was a missing piece that could help practitioners engage in longer-term planning and adjust for potential problems. They encouraged us to make the reserve adequacy analytical tool available to practitioners. The software you will see today is the result. So during today's webinar, we'd encourage you to ask questions at any point. To do so, just use the question box in the GoToWebinar control panel on the right of your screen. We'll try to answer many of them as we go along. So now I'm going to hand it over to Charlie to dig in deeper to the tool and show you how to use it. Charlie?
Thank you, Maya, and thanks everybody for attending today. I'm Charlie Wilkins. I worked with the Center for Housing Policy in the research that Maya discussed, and I also led the software development team for LCycle. Maya will continue operating the computer as we tour LCycle. LCycle starts with information about a property's reserves, its physical configuration, its cash flow, its debt service payments. Using that information, the software estimates the likely long-term capital needs. And by the way, when I use the term capital needs, I'm talking about the major repairs and replacements that the property is likely to encounter over its life. So replacing air conditioners, replacing carpets, replacing roofs, resurfacing parking lots, those kinds of things. So when you hear me use the term capital needs, if you think of that as being replacement reserve needs or major repairs or capital expenditures, you could substitute any of those terms and we'd be talking about the same thing. As Maya said, when you have a question, use the question box in the control panel on the right side of your screen. Generally, I'll stop and answer questions as they come in. First, we'll look at basic capabilities of the software. We'll create a sample property, and we'll use the standard economic assumptions. Then we can later talk about fine points. So the first thing we're going to see is the landing screen. This is what you will see when you enter the software. On this landing screen, there is a software introduction that will be useful for first-time users, and we'll have a look at that as we get into the software itself. And I'll take a moment and wait until the software shows up on everybody's screens. Then on this initial screen, you will see a couple of options. If you've registered before, there will be an opportunity to sign in. If you haven't registered before, then there's an opportunity to register. The reason that you register is that we save information that you enter about your property or the economic assumptions that you prefer, and this enables you to get back to that saved information. And by the way, we don't share that information with anybody. It's private for you. So there are no downsides to registering. And as Maya mentioned, the software is free. So Maya, if you'll click on the software information button before we go sign in. We're not going to spend any time on this during the webinar, but for a first-time user, this is a good overview of the software, how it works, what it will do for you, and why we developed it. Let's go ahead and close that out, but I did want to let everybody know it's there. There's also a privacy statement, which Maya will show you. So if you want to see, how we use any information that you provide, the details are there. As I mentioned, we don't use it at all. We leave it completely private. We don't share it with anybody. Let's go ahead and sign in. We registered earlier, so we're just going to put in our email address and the password we created the first time around. What you're now seeing is the properties screen. This is sort of home base for this software. You'll see at the top right of the screen a little house icon. This will bring you back to this screen from any place in the software. So if you wanted to enter a new property, if you wanted to modify the property you're working on and wanted to go back to the beginning, just click the little house icon. It'll bring you back here. So we're going to create a property at this point. And Maya's going to be filling in some information on our typical property. The project name will just help you remember which property it is. Same thing for city and state. This next box is fairly important. This is the year the property was constructed. So if it's a property that already exists, you would enter the year when you finish the rehab or finish the new construction. If it's a property that you're thinking about, you'll enter the year when you think you will complete the rehab or when you think you will complete the new construction. The project type is obvious. New construction, you're starting from scratch. Acquisition rehab, you've purchased a property and you're going to be fixing it up. The unit mix is fairly important. The number of units, of course, affects the number of things like hot water heaters and air conditioners. The square feet affects things like how much carpet you will need to replace when it comes time to do that. One of the features of the software is the blue balloons. There's one next to average square feet. You'll see that Maya just put the mouse over that bubble, and then you see extra information that we thought might be helpful for first-time users or for people who want to see what we mean by a particular term. And in this case, what you want to enter is what people call the net rentable square feet in the business. So this is the number of square feet inside the walls of the unit itself, not counting things like lobbies and hallways and elevators. In each of the screens in this software, at the bottom you're going to see navigation buttons. In this particular screen, there's only one navigation button, which is Save. Let's go ahead and click that. And this takes us to the next screen, which is Economic Assumptions. We include 3 standard economic assumption sets, and we're going to use one of those today. We're going to use the garden apartments set. We're going to use it without any changes, and so we're going to click that selection. And before we save it, I'd like to talk a little bit about some of the other things on this screen. The key economic assumptions include things like an assumption for interest rates, inflation rates, things like that. We made it easy for you by creating standard sets, but you also can create a custom set. You can do that in a couple of ways. The simplest way is to pick a standard set and to say create new with changes. You can also, that's the simplest way to do it. So if you just decided that you had a custom set of assumptions about inflation rates or interest rates or whatever, that would be the best way to create that. And then this would be saved in your profile, and you could go back to it later. Also on this screen, there is a Learn More tab, so let's click that. So this explains for you what it means when we say use without changes, what it means where we say create new with changes, etc. So you can go ahead and click Close tab. Generally speaking, in this software, we try to give you information on the screen itself that will help you figure out how to use the software. Let's go ahead and click Save now. And we can come back to economic assumptions later and see what the details are.
Before we move on to this, Charlie, we have one question that may affect a variety of people in the audience. One of the folks attending asked, is the one unit that's a non-revenue unit a manager's office?
Yes. When let's go back to the property screen, so we'll hit the little. Okay. The other way to get there is you can hit the Home button at the top right. You'll see that Maya put in one non-revenue unit and 100 two-bedroom revenue units. So this is a 101 unit property, 100 units for rent-paying residents, 1 unit probably for the manager. So in this case, there is a non-revenue unit, but of course the software will calculate replacement costs for the non-revenue unit as well as the revenue unit. So you'll see 101 units worth of capital needs when we get to that part of the software. And we can now use the navigation buttons. We can click Go to the next screen. By the way, whenever you click any of these navigation buttons, it saves what you did, and then we'll move forward. So here is a selection that we only see when we're using an acquisition rehab property. This tells when the property was originally built, and it talks about which of the building systems were replaced or are being replaced in the rehab part of our acquisition rehab transaction. So let's go ahead and put in 1978 as the year when the project was built. And then you'll see each of these building systems has a drop-down where we can say, are we replacing that now? So one selection is, yes, we're replacing it during the rehab. The next selection is, no, we're not. And the third selection is, that's not applicable to this project. So for example, if the project doesn't have air conditioning, you could select not applicable under air conditioning systems. The places where not applicable most frequently comes in are things like exterior stairs, balconies, things like that, that not every property has. We'll leave the rest of these as replaced during rehab. And this is fairly typical for low-income housing tax credit properties, at least for 9% tax credit properties. There's usually a lot of rehab that's done in an acquisition rehab project. We can go ahead and click Go to Next Screen. Now we're into hard debt. And when we use that term in the software, what we're referring to is a mortgage payment that has to get made every month whether you have positive cash flow or not. So in other words, a standard, typical commercial first mortgage loan. And Maya's going to go ahead and enter some information on the mortgage loan for this property. The software will calculate the principal and interest payment. It will calculate the mortgage insurance premium and then calculate the full debt service amount. And when I use the term debt service, what that means is principal, interest, and anything else like private mortgage insurance or an FHA mortgage insurance premium. When you're using the software, you'll want to look at the calculated annual debt service and make sure it matches the number you're expecting. So for example, if your lender is using an unusual loan payment, then you may need to fiddle with the assumptions here so that the debt service amount matches what's in your loan commitment. Let's go ahead and go to the next screen, and this will save our work, as I mentioned earlier. Now we're on the replacement reserve screen, and there's two key pieces of information that Maya will be putting in up at the top. The first one is, what's the initial deposit? So as part of building the project, are we going to put a down payment, if you will, in the replacement reserve account? In this case, we're not, but in a number of projects, you might see something like that. And then the next piece is, what is the annual reserve deposit? And in our sample, we're using an annual reserve deposit that's fairly typical for what many people do when developing an apartment property. $300 a unit a year is sort of a rule of thumb in the business. We're going to test the rule of thumb and see how well it works in this particular transaction. Next, we're going to select a set of replacement costs. The software got these replacement costs from OnSite Insight, which is one of the firms that does capital needs assessment and capital planning for apartment properties. We have three sets of replacement costs for low, medium, and high cost areas. We're going to select low cost here. Our sample property is in Macon, Georgia, and that is a low cost area. So if you wanted to see what the replacement costs consist of, you could click, which Maya is going to do now, on low cost area, and this shows you what the assumptions are. You could print this screen if you wanted to, but this shows you how we measured each of the replacement costs and what the actual number is. You would have the ability to create custom replacement costs. You can do that as part of the custom economic assumptions option. So if you have information like that, you could fine-tune these assumptions just like any of the other assumptions. Okay, let's go back. We've selected the low-cost profile, and we're now going to go on to the next screen.
Before we go on, we have a question about whether the beginning balance would be the amount 3 years ago or the current balance. Like if you were doing this for the property that's already built.
The beginning balance would be the amount that was actually deposited when the property was built. So this is a property that already exists. Construction was completed in 2005. This would be the amount that was actually deposited back then. If this was a property that was going to be developed, this would be the amount that you intend to deposit, probably somewhere between the initial closing before construction and the final closing when the permanent loan goes in place. So in other words, this is before any interest accrues after the initial deposit is made. Now we're to the cash flow screen. There's a Learn More tab on this screen as well, which gives you additional information that, in particular, a first-time user might need. And we can close that, but I just wanted you to know it was there. Maya's going to be entering some information while we're talking about the screen. Gross potential rent is a real estate term of art. It means the rent you would collect if all units were occupied and everybody paid the full rent. Rent loss includes vacancy and bad debt. We're entering all the numbers as positive numbers. The software figures out which one is cash in and which one is cash out, so you don't have to worry about that. Other income is things like laundry income, bad check fees, tenant damage charges, those kinds of things. The replacement reserve deposit we already entered on a previous screen. And the software calculates the net operating income. This is the cash flow of the property before we make a mortgage payment. You should always check to see whether this matches the number you're expecting. Usually when you're doing this, you'll be looking at an internal pro forma that you've put together, and you always want to check to make sure the software is coming up with the same number you are expecting. So from the net operating income, we subtract the debt service, and this gives you the operating cash flow. The next item, first year of stabilized cash flow, is a pretty important entry in the software. So this is the first year when you have a full year of normal operations after lease up. So in this sample property, construction got completed in 2005, 2006 was a lease-up year, and 2007 would be the first year of normal operations. The next entry is what you want the software to do about annual rent increases. Usually you would select the first item, which is that the rents are going to adjust using whatever inflation factor you have selected. The second option could be useful if this is a Department of Agriculture 515 property, or perhaps a HUD Section 202 property where the rents are based on operating costs. We're going to select the inflation factor approach because that's the one that would be most typical for the properties that most users would be testing. We're now going to click I'm done now. Whenever you see that one, if you click it, it'll take you straight to the punchline. And while the punchline is being calculated, what you're going to see is the gray screen and the little rotating icon. This gives time for the software to calculate the graph and to display it. And I'm going to talk a little about this graph. This is how the software tells you what's going on for this property. The green line, I think of that as the money line. This is how much money has been deposited in the replacement reserve to date. So at the beginning in 2005, there's nothing there because there was no initial deposit. And you'll see the green line steadily rises to the right because annual deposits are being made and interest is being earned. The next line is the blue line. This is all of the major repairs and replacements that have accrued thus far. So this would be, in the early years, carpet replacements, hot water heater replacements. In years 10 to 15, you're going to see things like air conditioners. About years 15 to 20, you're going to start seeing refrigerators. Years 20 to 30, you'll see the furnaces, roofs, parking lot resurfacing, windows, things like that. And what we find is there's something of a witching hour at about year 30. So that's the second vertical line you see on the graph. In year 30, we get the third replacement of 10-year items like water heaters. We get the second replacement of 15-year items like refrigerators and air conditioners. And we get the first replacement of year 30 items like windows. So typically we see a big bump in the blue line in year 30. And in typical properties, this is when the property really runs into trouble. In our sample property, you'll see that we get a little blip of trouble at year 15, and now it's time to look at the red line. These are the deficits. This is when the funding is not adequate for the needs. You see a little bit of a deficit hit in year 15. It bumps up a little bit in year 20, stays relatively low through year 30, takes a big bump, and then gets steadily worse from there. This is a fairly typical graph that we see when we're using this software. And since we used a sort of industry rule of thumb reserve deposit, we're seeing what typically happens when people use the rule of thumb. The reserve barely gets you by through about year 15. Things are uncomfortable for the next 10 or 15 years, and then things are really uncomfortable after that. So what could we do about that? So one thing we could think of is we could refinance the property. So let's try the refinancing scenario, and let's see what the software tells us about that. So it'll be back to us in a little bit with a revised graph. And what it's going to do is to say, what if we refinance the property 2 years before the first problem? The first problem is in year 15. The software, therefore, is going to test a refinance in year 13. And by the way, that 2-year differential is something you can control by using the economic assumptions. And here's what we see. The green line takes a nice jump upward in year 13 because we're refinancing the property. The refinancing generates net proceeds. We're putting all of those in the reserve in this artificial scenario. The green line bumps up. It's adequate until year 30, but in year 30, the needs blow right through the available funds, and we're back in trouble again, which in practice would mean probably we'd have to refinance again in somewhere between year 25 and year 30. Let's take a look at a different scenario, which is the cash flow scenario. In this approach, we start using the cash flow of the property and putting it in the replacement reserve. Now, this is a hypothetical scenario. In real life, an owner wouldn't do it exactly that way. The owner would probably decide year by year whether some of the cash flow needed to be used for roof replacement or whatever. But here we see, if we start putting all the cash flow in the reserve at year 13, we have enough money through year 30, and we have enough money thereafter. So what this tells us is refinancing the property once won't get us there. Using all the cash flow gets us there with a lot of room to spare. And what that suggests is that there are probably a number of ways we could get this property right side up. We could use a bigger annual reserve deposit. We could refinance the property once and then use some of the cash flow. We could refinance the property once, refinance it again, maybe in year 25. Or we could do some combination. We could use a larger annual deposit, but not so large that it completely solves the problem. And then we could use some of the cash flow or do a refinance. So in using the software in this way, you sort of get a sense of whether the property is going to need something besides the normal reserve deposit, when it's going to need that, and how badly it's going to need it. Let's go back to the base case just to see, refresh our memory on what happens if we don't use any cash flow and if we don't do any refinancing. Basically, pretty ugly. So if we use the reserve deposit that we're thinking about, we pretty much know that maybe as early as year 15, certainly not long after that, we're going to have to start dipping into cash flow, refinancing, resyndicate the property, or something like that. And if we were talking to investors, then they would probably be doing calculations like that themselves, but we would also tell them, hey, look, we're using a fairly small reserve deposit here. We're going to have to be making additional investments as the property ages. So don't do a simple calculation and assume that all the cash flow is going to be available to go toward other investments. We're probably going to have to use a lot of it to take care of the property's needs. What I want to do now is to do a little bit of what if. It'll show you some ways we could use this software to test some alternative ways of dealing with our problem. And the first thing I'd like to check is how we could make an additional deposit to the replacement reserve at the closing. So in other words, prime the pump a little bit. Let's go to the replacement reserve screen. You'll see up at the top these boxes that Maya is highlighting. These let you move around inside the software. So we're going to go back to replacement reserve, and let's just arbitrarily put a beginning balance of $1 million in there. That's about $10,000 a unit. And let's go, I'm done now. Now you notice, since we've already put in the rest of the information, the software shows us the I'm done now option anytime we go back. So we can fairly easily hop around in the software and change things to see what happens. And this is about what you'd expect. The green line no longer starts at 0, it starts at 1 million, and it slopes up steadily after that. This pretty much shoves our problem off to about year 30. Let's see what happens if we use the refinancing scenario in combination with an additional $1 million at the beginning. And I'm going to suspect this is going to work pretty well because we had a 30-year first mortgage. It's going to be mostly paid off by the time we refinance, and here we go. A nice big bump in the green line when we refinance, and it works pretty well until about year 35 or 40. So even here, refinancing just once doesn't quite get the job done. Let's try the cash flow scenario and see how that works in combination with our additional $1 million at the beginning. And this is probably going to work pretty well. Yup. Although you notice there is a little bit of a blip between years about 30 and 33 where we still run negative. So what this is suggesting to me is putting more money in at the beginning is good, but probably what we really need to do is put more in each year. So we're going to take a look at that now. Let's go back to the replacement reserve screen. We're going to use the navigation buttons up at the top. like before. Let's take out the $1 million. Let's go back to the zero that we started with for a beginning balance. And then we're, in addition to that, instead of $30,000 a year, let's try arbitrarily $50,000 a year and see how that works. So that's about $500 a unit a year. And we'll see how that works. This is sort of an arbitrary what if. It's the kind of thing I might do if I were thinking about developing this property. So let's see what $500 a unit a year does. And let's go back and look at the base case before we look at the cash flow scenario. And the base case is what we get when we're not using any of the cash flow, when we're not assuming any sort of a refinance. So we'll go back and select the base case scenario, and let's see what that graph looks like. So this is same as before, but we're using a $500 a unit a year reserve deposit instead of $300 a unit a year. Well, that looks better, but there are still problems. So if you're a rule of thumb sort of person, remember that $300 a unit a year got us through about year 15. $500 a unit a year got us through about year 30, but still doesn't get the job done in the long run. Let's try refinancing on top of this and see how that works. So $500 a unit a year as the reserve deposit, and looking at a refinance probably in year 25 to 28. No, actually it's refinancing earlier than that. So again, we're okay until about year 30, and we still have a problem after that. So if this were my property and I was looking at long-term viability, I'd be thinking about either $500 a unit a year and a modest initial deposit, or maybe $600 a unit a year in the reserve, something like that, so that the reserve would be enough to take care of the property's capital needs. Alternatively, when I'm talking to my funding partners, I'd let them know that we're going to need to use some refinancing proceeds and some of the cash flow as the property gets to about year 20 to 25 to 30.
Charlie, we had a participant question about how the software actually determined the best year to refinance, or if you indicated that somewhere.
Okay. This is controlled in the economic assumptions. So in the cash flow scenario, the standard assumption is we start using cash flow 5 years before the first deficit. In the refinancing scenario, we refinance 2 years before the first deficit. And the 5 years and 2 years are under your control. You can select an alternative economic assumption and make that happen any year that you choose for it to happen, basically. The reason we selected those as standard assumptions is when talking with owners and managers, they basically said, if we're doing capital needs assessments periodically, which is what most people in the business do, we're going to spot these problems coming. We're going to know several years in advance, and we'll have the opportunity to decide to set cash flow aside, maybe to decide to increase the reserve deposit, maybe to decide to refinance. And so we think we'll be able to spot the problem coming, and we'll be able to do something modestly in advance of the occurrence of a problem. And that that sort of jives with my experience as a developer, owner, manager. We did that sort of analysis in-house, and we knew when the problems were coming. So as a sidebar, if any of you are asset managers or property managers and you're not doing that sort of analysis, it would be a good idea to start doing it so you have some advance warning of future problems. But there's something I'm going to worry about. We just arbitrarily increased our reserve deposit. I'm wondering if we had enough cash flow available to be able to do that. So I want to go back to the cash flow screen and see what that looks like. So in the real world, we can't just arbitrarily increase our reserve deposit. We have to be sure we can pay for it. So we're going to use the navigation buttons at the top. We're going to go back to the cash flow screen. And lo and behold, look here. After our bigger $50,000 reserve deposit, look at our operating cash flow. Oops, only $5,000, and look at the line above that. It's only a 1.03 debt service coverage ratio. So for those of you who are not real estate finance aficionados, debt service coverage is a calculation, it's a ratio. The numerator, which is on the top of the bar, the numerator is net operating income, the denominator is debt service. So in this case, 175,000 divided by 169,672 means there's $1.03 of NOI for each dollar of mortgage payment. Industry rule of thumb is at about 1.20, people tend to not worry so much. Below 1.20, they worry increasingly. Below about 1.10, they worry a lot. So 1.03 is really not enough. And what that would mean to me as a developer is if I'm going to use a $50,000 reserve deposit, I'm going to have to reduce my first mortgage loan so I have a little bit more breathing room in this property. So Maya, let's go back to the hard debt screen, and we're going to reduce the mortgage loan. Let's reduce it to $1.8 million instead of $2 million, and let's see what that does. It's going to reduce the mortgage payment, and it'll give us a little more breathing room, and I just want to see how much breathing room it gives us. So let's
1.8 million, right?
1.8 million. Let's do a save, and let's go back to the cash flow screen and see what that tells us. Okay, now we're up to a 1.15 debt service coverage ratio. That's on the calculated debt service line, and that's getting into the marginal and reasonably okay range. Not super safe, but reasonably okay. So that's sort of more like it.
So we have a couple of questions that came in. I don't know if you want to, they're about customization. We had some questions about customizing if you're working for single family, with single family units, what happens and what, is there any way to shift things around for that, and what factors would you have to adjust? And we had another question about customization that's more about what if you have either a mixed-use building or an area where you've got a fair amount of common space? How are the capital needs captured for those sorts of cases?
Okay, we'll take those in sequence. If you have a property consisting of single-family units, the first thing we're going to look at is to go back to the property screen. So let's hit the little home icon at the top and look at our webinar test property. What we're going to see probably, if we're doing single-family properties, we're going to see bigger units. We're going to see 3-bedroom, 4-bedroom, 5-bedroom. We're also going to see higher square feet per unit. So that's the first place where we're going to see a change. Let's go ahead and go to the next screen. And now's the time, and let's go to the next, let's hit key economic assumptions up at the top. And let's just click on garden apartments. And we'll see what economic assumptions are in here. And I'm going to talk about all of these economic assumptions on the way toward the ones that will matter for single family. The first set has to do with inflation. The software assumes 2.5% general inflation. So this is on average. What rate of inflation would you expect over the 50 years? So this is a guess. 2.5% is a reasonable guess. You may have a different guess. And then the next question is, do we think rents will inflate at a different rate than general inflation? Same thing for operating expenses, etc. And then down at the bottom, long-term treasury rate, we're expecting, normally you would think the long-term rate is going to be higher than the rate of inflation, and that's what we assume. So at a 2.5 general inflation rate, add 2.5 to that, and we'd have a long-term treasury rate at 5%. And you can change those if you have a different view. The next block is assumptions related to refinancing. The software uses a pretty conservative set of refinancing assumptions. A 7% interest rate, 75% loan-to-value limitation, 25-year amortization, and a 1.50 debt service coverage. These are pretty conservative assumptions. You may want to be more aggressive. In the software, we like to be conservative about it because you never know whether you're going to be able to refinance when you want to. Maybe the property is having occupancy problems. Maybe interest rates are especially high. Maybe it's especially hard to refinance at that time. So because refinancing can't be counted on, we set the standard assumptions up to be pretty conservative. The next block is expected useful life assumptions. These come from On-Site Insight. They're based on the Fannie Mae standard useful life tables. These are pretty reasonable numbers, but you may have different assumptions for your particular project. For example, on the roof, maybe you're using more expensive shingles that have a 40-year life or a 30-year life instead of the industry standard 20. So you could adjust that. And let's scroll down and see what else is in standard assumptions. Capital needs parameters. Here's where you can customize your project. If you were using one-story single-family buildings, you would change the number of stories from 2 to 1. If you were doing a single-family property, you would change the next item, number of units per building. That would be 1 for a single-family property. And then these other assumptions give you a chance to get even more technical and to talk about how steep the roof is, are you using gutters, how much siding is there. For a single family building, you'd want to up this because you're going to have only one unit in the building and you're going to have a lot of siding for each unit. And finally, some valuation assumptions. Capitalization rate is used for figuring out some of the refinancing options. And here at the end, the cash flow test. Start depositing cash flow to the reserve how many years before the first deficit. And the standard assumption is 5 years. You could change that if you wanted to. And for refinancing, refinance how many years in advance of the first problem. The software standard assumption is 2 years. You could change that if you had a different view. So I think you can see just from this quick tour that you have a lot of ability to control the software. So in other words, we didn't want this to be a black box. We wanted it to be something that users could go as deep into as they wanted to. Some people may want to get way down in the weeds. Other people may want to use the standard assumption sets and never think about customizing. And we wanted both kinds of users to be able to use the software and get good results.
So if you did want to do a single family and you thought Garden Apartments is going to be the easiest one to build off of, you would click right on Create New with changes based on. And as you move forward with that, you would be able to name it. And
so we could call this, yeah, if we did that, we could call it, let's hit the save again.
Mm-hmm.
And we could call it Charlie's Single Family, for example. And then it would save in our profile, and we could come back and use that set of assumptions the next time we had a property that had single-family buildings in it. So that's sort of a long response to the question about what if I had single-family units. And the next question was, what if I have a lot of common area?
All right, hold on. I am getting out of that rabbit hole.
Okay. So we'll go back and look at our webinar test property. Let's go to the next screen and go into key economic assumptions. And we'll go into Garden Apartments. And I want to look at the capital needs parameters that are down towards the bottom. Here we go. Let's see here. I'll have to take a look at that offline. I thought I had an economic assumption that dealt with the common areas, and I'll check that after the webinar and see where that is. So if you want, you can email to the CHP feedback email, whoever asked that question, and we'll find an answer for you and get back to you by email.
We have a couple of other questions in here too. One is about how you would use this with capital needs assessments, and another is about if you were the owner of an existing building trying to use this software to look at your current reserve deposit, what would you choose? Would you say you were new construction or acquisition rehab? How would you approach that?
Okay, we'll take those questions in sequence. And the first one was, what if I already have a capital needs assessment? So the first thing that I would think about is I now have a better set of information about replacement costs. And I might want to go in and tweak the replacement cost assumptions so that they match my capital needs assessment. And I also want to see what the capital needs assessor said about useful lives, because there could be some non-standard useful lives. So that might be an occasion when I would want to use the economic assumptions, create a custom set, and fit those to what my capital needs assessment provider said. And one question that would come up is, if I have a capital needs assessment, would I use this software at all? And if I still had my capital needs assessment provider in the room, so I was in the process of reviewing a draft report, then I could ask the capital needs assessment provider to look at some of the alternative scenarios, and maybe I wouldn't need this software at all. But more likely, you already bought the capital needs assessment, and now you're thinking about what if. This software could be a good way of doing the what if analysis. So you could look at different combinations of initial reserve deposit, annual reserve deposit, refinancing, use of cash flow, and you could use the graph to get a visual sense of when the problems are going to occur and how severe they're going to be. So with the capital needs assessment in hand, first I'd think about customizing my economic assumptions, or at least selecting the standard assumption set that most closely fits what my capital needs assessment provider came up with. And then using the software to test different ways of dealing with whatever problems there might be. The second question we had was, what if this is an existing property that maybe I did 10 years ago? And the way I would think about that, let's say it was a new construction property that I built 10 years ago. I would put this one in as a new construction property with the construction being completed in the year 2003, 10 years ago. And then I would, in my replacement reserve screen, I would put in whatever initial deposit I actually made when I built the project, and I would put in the reserve deposit that I actually started with when the property was built 10 years ago. And then I'd see what the software tells me. I'd look at my graph at the end, and I'd ask my property manager, does this look like what actually happened? And then you'd have a discussion with your property manager, and that might lead you to go back and select some different economic assumptions or select a higher cost set of replacement costs or something like that. And then that would, I would look at my graph and say, when are my problems going to occur? How close am I to that date? What does the software suggest about possible solutions? And then I'd start talking to my financing partners about maybe we should be setting some cash flow aside, maybe we should be increasing our reserve deposit, maybe we should think about refinancing. And this could be a useful sort of early warning system for a property that's already built. Similarly, if we did the property 10 years ago and it was an acquisition rehab at that point, you could do something similar. On this create a property screen, you could say 2003 is the year in which rehab was completed. You could select acquisition rehab and go from there.
So recognizing
that's the way I would use the software, and maybe other people would have a slightly different view, but that'll give you a sense of how you could use the software to help with that situation.
Recognizing that we told people we'd be over at 3 and we're just slightly over, I want to try to make sure that everybody knows how to stay in touch and how to continue the conversation with us afterwards. We have a couple of questions we didn't get to, but we will certainly try to follow up with you all. Charlie, is there anything you want to close with before I let people know how to stay in touch?
No, other than thank you for participating. We hope you use the software. Let us know how it worked for you, and we'd be delighted to hear from you.
Yeah, thanks, Charlie, so much for doing this, for being part of this project, and helping to really contribute something that I think could be a tremendously valuable tool for the industry. And I want to thank all of you who were on the webinar today, and thank the MacArthur Foundation again for its generous support of the project. The full set of materials from this research project, all the papers as well as the LCycle tool link and the webinar archives for this and a prior webinar are all able to be found at nhc.org/LCycle. Once this webinar is available and online, we'll send a link out to all of you to let you know. And we want to keep hearing from you after the webinar is over to help us continue ensuring that this tool is really useful for your work, helping you understand how how to use it, and also learning how to continue improving the tool. This is a fairly new release of ours, and we certainly don't think that that the work on it is all done. So if you find things that you want to suggest for improvements, we are all ears, and we'll maintain a list of those in case that's something we can tweak and fix. Anyway, please email us. The email address is chp-feedback@nhc.org. You can also post questions in the housingpolicy.org forum, which I monitor regularly, and also helps you to reach a wider audience in case others of you can kind of crowdsource answers. The housingpolicy.org forum is forum.housingpolicy.org. We are always interested in hearing your feedback, comments, and questions, and you can also learn about more events happening at the National Housing Conference by visiting nhc.org/events.